get started tonight. Asked how the weekend was, not the weekend, just got a new 15 minutes ago. I got an offer on a house. Hey, great job, Annalise, sweet. So you're buying a new house?
Yeah, in Pasadena, so super exciting.
Hey, great, yep. Congratulations, that's awesome.
Thank you, we'll settle the day before Thanksgiving, so right before the holidays.
Hey, that's great, just in time to have everybody over to help you unpack all your boxes.
Yeah, exactly.
Hey, if you're going to come eat, if I'm providing the food, you're helping, you're doing the work.
Right, they do the labor.
That's exactly right. I'm a big fan of that. If you need some help, I work for beer.
I'll keep that in mind.
All right, let's go ahead and get started tonight. All right, we got a kind of a jam-packed night tonight. We're going to go through 4 different things. I've got some notes in front of me, so if I'm looking down, I'm just making sure that I'm going to go through the things we need to cover tonight. So first thing I want to talk about is the midterm. All right, and everyone should have gotten an email back from me with your graded midterm, and please forgive me for not like personalizing every email. Most of them I just sent your graded midterm because we're going to talk about it tonight. We're going to go through the data detective reboot and what that entails and when that's due. We're going to get into the Heritage Doll case. Okay, that's probably going to be about a half an hour discussion. Okay, to kind of help you with the case analysis that's due next week. All right, and we're going to go through the first of the 2 projects that the Heritage Doll Company is evaluating, and I'll pull up Excel and we'll kind of walk through some of the numbers so that you can kind of see if you're having trouble with the discounted cash flow analysis. I'm going to give you some insight into kind of what it looks like and how it needs to be developed, because there's some nuances to the second project that they're looking at evaluating that are slightly different than the first project. Okay, so we'll get into that. And then finally, we'll get into chapter 7 of the text that deals with interest rates and bond valuation. So first things first, like, good job getting through the midterm, because everything up until the midterm, everything kind of built upon itself, right? We talked about the basic corporate structures, and we got into the financial statements, and we got into how they talk to each other, okay, between the income statement and the balance sheet, retained earnings and common stock and time value of money, discounted cash flow valuation, how we go about selecting one project over another based upon the net present value and IRR, and everything just kind of built upon itself, right? From here on out, it's more discrete learning, okay? Tonight, we're going to talk about bond valuation. Next week, we're going to talk about stock valuation, equity valuation. And we're going to get into, after that, weighted average cost of capital and just securities markets in general. Okay, so it's more discrete learning. So congratulations for making it through like the hardest part of the entire semester, okay, which was getting through the midterm, right? So let's go ahead and start with kind of a review of the midterm. So here's how I teach. I never give partial credit, right? Because in the jobs that you all have, there is no partial credit. You make a mistake in an Excel file that's dealing with valuation of a company or valuation of a project or valuation of some marketing promotion that you're looking at doing. You make one mistake, and that can potentially cost your company tens to hundreds of millions of dollars. Okay, and I've seen it happen. Trust me, I've seen it happen time and time again. Okay, so I don't give partial credit. So we're going to go through tonight. I'm going to go through the midterm with you. I'm going to go through the answer key, right? I'm not going to record the section of the video tonight, of the lecture tonight, where I actually show you all of the answers. So you need to pay attention, because what I'm going to give you is, if you're not happy with your grade, you can resubmit your midterm exam answers, okay, for all the points back. Okay, so I'm going to teach you the mistakes that you made. My expectation is that you're going to take that gift and you're going to come back and you're going to resubmit your midterm to me. Okay, and I'll regrade it for full points. Okay, because my goal is not to make this the hardest class you're going to take in the Sellinger MBA program. My goal is to help you learn and understand the material so that when you go and you're sitting in meetings with folks in finance and you're talking about potential projects that your company is looking at, that A, not only can you speak the language that the finance people are speaking, but you're able to also contribute productively during the conversations that you're going to be having with those people. Okay, so I give clean grades, and many of the grades that you guys received, the errors would just flow through errors. You made one mistake and it cost you 15 extra points. Okay, so you fix one mistake and bam, you're back in the money. Okay, you've got 15 extra points on top of your grade. Okay, so we're going to go through the midterm now. I'm going to share my screen. Okay, and we're going to go ahead and get started. And I'm going to pause the recording now. All right, so that I'm not giving away the answers. You actually do have to do some work. All right, but I'm going to go through it with you. Resume recording, and here we go. All right, let's talk about Heritage Doll. What is Heritage Doll facing? All right, it's time just to have a conversation. All right, what are they looking at? What decisions are they looking at having to make?
They have to decide between two projects right now. It's, if I'm remembering correctly, make your own doll versus design your own doll.
Yep.
To kind of help with the growth of the company and certain problems that they're facing. One being, seasonality.
Yep. Okay, keep going. Somebody else who had some seasonality issues that are involved in the project, that's for sure. What about in terms of just overall risk between the two projects?
One of them seemed to be more of a new product launch, which was a higher capital investment to begin with. It's quite significant compared to the line extension, which was the first one.
Yep.
So you're kind of looking at the overall capital investments that are needed to begin each of the projects.
Okay. So the design your own doll project definitely came along with some additional higher investment costs. It's a little riskier because they're doing something above and beyond what their traditional line of business has been. Okay, great. What else? What about in terms of just the overall doll industry itself and the rate of growth that Heritage has experienced, recently? And what is the difference between those two numbers? How does that potentially impact the decision-making process for can Heritage do both of these projects, or do they have to pick one versus the other?
They have to pick one, if I'm remembering correctly. And then I know at the beginning of the case, it mentioned that they might have to bring forth, the person deciding might have to bring forth, if they don't like either of the two capital projects, one of her own. But it seems like that's, based off the Excel sheet you provided, that's not really an option. So it's kind of just between the two and pick the best one.
Right. Okay. So the goal of the assignment, right, is to develop the discounted cash flows for the two projects that are being considered. In your written assignment, to Annalise's point, is maybe there's wiser use of the capital elsewhere. Okay. And granted, you weren't necessarily given any information related to other projects that they might be considering, but always keep that in the back of your mind, that even though the economics of one of these two projects might suggest that we do one versus the other, there should always be that check that says, yes, if we have to pick one of these two projects, this is the one we should do, but let's just make sure that there's not a wiser use of our capital. Okay, so when you're doing your written assignment, don't forget that little unknown. Okay, that yeah, you're kind of being asked to evaluate two projects, but don't lose sight of the fact that it's still cash that the company is looking at using, cash that they've worked hard to obtain, and maybe there's a better alternative. Okay, the case doesn't give you an idea of what that better alternative might be, but that might be a question that needs to get asked. Okay, once you figure out which project you're going to recommend that they do. Okay, great. So I'm just going through my case notes because I've taught this a few times, right? So in terms of the discounted cash flow for the first project, let's just kind of walk through it, okay? So let's go through the first project, okay? The Match My Doll clothing line, okay? And I'm gonna just kind of share my screen again here. If I can get back on it. Where did everything go? Where did it all go? Okay, here we go. Okay. So when we're talking about the Match My Doll clothing line, okay, pretty much like everything from row 27 through row 1 was given to you, was provided to you. And your job was to build out, okay, the net working capital accounts, okay, to build out the CapEx line items, because our ultimate goal here was to get to free cash flow. Okay, just like you did in the midterm where we dealt very specifically with operating cash flow, which was just simply, you know, EBITDA minus taxes. Now we're just getting a little bit more complex, okay? And we're layering in changes in net working capital. Because remember, some projects, a lot of projects require additional maintenance every year in terms of keeping that project running and ongoing from the time you start the project to the time it ceases to exist. So there is a working capital implication for putting projects in place. So when we talk about free cash flow, right, we're talking about EBITDA minus taxes, minus the change in net working capital, minus any additional capital that's required to keep that project running every year. Okay, so when I was working for BP in Houston, and we were building chemical plants on top of a big patch of grass, right? We've had a lot of money that got put into building the plant, right? And then when we turned the switch on and the chemical plant started producing product that then started generating revenue, okay? We still had things that we needed to do within that chemical plant to keep it running, right? There were capital expenditures that had to be ongoing to keep those pieces of equipment in tip-top shape to keep producing the product. So it wasn't an initial capital outlay and then everything was done. There was kind of an ongoing capital expense that was associated with the chemical plant, okay, in order to make sure that the plant continued to run properly. So additional capital expenditures required. No different than in this example here with the Match My Doll clothing line. Okay, so you were given information about working capital assumptions. Okay, you needed to determine the accounts receivable, the inventory, the accounts payable, and the net working capital. Because that way you could, those 4 items, you can calculate net working capital, right? Because what's net working capital? Well, net working capital is nothing other than cash plus accounts receivable plus inventory minus accounts payable. Okay, just like we talked about a number of weeks ago. Okay, so we can calculate the working capital for every year, right? And then based upon what we know from the prior year, the case tells us that this particular project requires an initial working capital outlay of $800 million, okay? $800,000, right? Once we calculate the working capital requirements for 2011, we can now calculate the change in net working capital from 2010 to 2011 of $107,000. Okay. Once we have the change in net working capital, that's the third component to our free cash flow calculation. So when we get into free cash flow, okay, we have EBIT adjusted for taxes. So EBIT minus taxes. All right. We add back depreciation, which is given to us, minus the change in net working capital, minus the capital expenditures for the year, which we are given, okay, up here in row 26, we're given that number to get to our free cash flow for 2011 for the project. Okay? And then once we've got that first year done, it's nothing more than a click and drag all the way out through year 2020, okay, for the case. So now we know that just like we did on the midterm, we're moving towards this net present value analysis, right? Okay. So we know that we've got this future stream of cash flows for the next 10 years from the project. But now we need to know, well, what's the present value of all of those future cash flow streams beyond 2020 in perpetuity for the project? Okay. To do that, we calculate what's called the terminal value. And when we get into equity valuation, we'll talk at further detail about the terminal value, right? But if you did some research within the text, you'd be able to find that the terminal value, the future value brought back into today's dollars, okay, eventually, but the future value, the future stream of cash flows as valued, okay, is treated as a perpetuity. And when we do that, we can see that we grow the final year's free cash flow. Okay, the final year, we grow it by 3%. So that's giving us essentially an estimate of 2021. Okay, so we're growing the last year by the 3% growth rate. Okay, and we're dividing that by the difference between the discount factor and the terminal value. Okay, the growth rate. So 8.4 minus 3, the difference between the two of those. That gives us the perpetuity value, the terminal value in future dollars of what the future cash flow streams of this project represents to the firm. Okay, so when we get into the next phase here, where we bring all of those future dollars into today's dollars, okay, you'll see that we have at an 8.4% discount rate, we have a stream of discount factors. Okay, we have a stream of present value dollars where we're simply taking the future value, okay, in each year, and we're bringing it into today's dollars. So in 2010, okay, the cash outlays are not only, okay, the $750 negative of free cash flow, because remember, okay, remember where that came from. Where did we come up with the 750? Okay, remember, it's operating profit times 1 minus the tax rate, right? That's the EBIT at the tax adjusted EBIT for that year, all right? So we have 750, obviously negative because we're shelling out money. We don't have revenue coming in. We're spending money on working capital. We've got to put money in the bank to fund working capital. We got to put money into the project for PPE. So our actual total cash outlay for the business in year 0 times 0 is the sum of the free cash flow in that year plus the net working capital outlay plus the net PP&E, all of which is given to you within the case. Okay, those pieces are told to you, right? And then we multiply that by the discount factor for year 0, which is obviously 1. And we get the present value of our day 0 component to the free cash flow analysis. And then from there on out, it's just simply the free cash flow times the discount factor gives us the PV, okay? And when we sum all of those things up, we get the net present value, okay? And then it starts to get into a little question about what's the net present value of the project excluding the terminal value? And this is where in your written analysis, you need to give some thought between the two projects, okay? Because when you're doing DCF analysis for your companies in the real world, right? This terminal value can have a big impact on the overall net present value of the project that you're looking at considering. Okay? Because you're talking about trying to come up with some number that you're willing to pay for that exists well beyond the 10-year horizon that you might be comfortable forecasting. Okay? So there's a lot of assumptions in your jobs, in your companies, that have to go into figuring out what a very realistic terminal value is for the project that you're evaluating. Okay? But in this case, we kept it fairly simple. Okay? And then you've got the IRR and the payback analysis and the profitability index that you're used to using. Okay? So that is the discounted cash flow for the Match My Doll clothing. Right? And you need to translate that into the design your own doll. Okay? Using the different parameters that the design your own doll project has within it, because there are some different parameters. Okay? You've got some additional expenses that are not included within the Match My Doll clothing line. So you're going to have some additional data that you're going to have to evaluate, but the process is nonetheless the same. Okay? You have a projection of an income statement. You have to determine working capital accounts based upon the data that you're provided. You have to determine change in net working capital. You have to come up with your free cash flows on a future value basis based upon the money that is going out the door today, okay, and the future stream of cash flows that are coming in the door. You have to look at the difference in discount rates based upon the level of risk of these two projects, and they give you information in the case around what those discount rates should be. To then calculate net present value for the project, both including a terminal value and excluding a terminal value. Okay? Any questions? And does that help you better understand the DCF exercise within the case? As you have time to review, all of this is now being obviously recorded, so you'll have time to go back and take a look at what we just talked about in terms of this particular project that Heritage Doll is evaluating. So one of the exercises that we're going to do next week is we're going to get into the capital budgeting simulation. Okay, and the capital budgeting simulation is going to deal with Heritage Doll again, but not necessarily two mutually exclusive projects, but you will be given an allocation of capital money to spend as you see fit in order to maximize value for the firm over a 10-year period of time. So this is leading us into a much broader conversation around the entire capital budgeting process. Okay. All right. Right. So that's the DCF. So let's talk about bonds. All right, let's totally change gears. All right, and go into bond valuation. So tonight, we're going to continue on the time value of money theme. Okay. I warned you that you can never escape the future value formula, FV equals PV times 1 plus the rate to the time period. And as you're going to see tonight, and as you're going to see next week, it's used in so many different aspects of finance and investing. Right? So we're going to talk about bond valuation and the impact that interest rates have on the calculation of bond prices within the market. Okay. Talk about some of the key features of bonds, the terminology, the verbiage that goes along with bonds, and in terms of individual bonds. Okay, you may be familiar with a fixed income bond mutual fund within your 401k offering, but we're going to be talking about specifically the individual bonds that one mutual fund is made up of. Okay, we're going to talk about how bonds are priced, what yields mean, how the rating agencies come up with the investment grade or junk bond ratings that they have for bonds. We'll get into a little more detail around the interest rate and how the interest rate can change the rate of change. Okay, so the first derivative of the bond price is what we call duration. Okay, we're going to talk a little bit about convexity, meaning the rate of change at which the bond price moves as interest rates move. Okay, and finally, we'll just talk a little bit about some of the structure of interest rates and how that impacts the determinants of the bond yields. Okay, if all of that makes zero sense to you, fear not. Okay, it will all make sense when we finish tonight, and it will all tie back into the future value formula that we've been working on as it relates to discounted cash flow valuation from the midterm, discounted cash flow valuation for Heritage Dole, and the 4 basic time value of money calculations that you've already done within the midterm. Okay, so before we get into calculating bond prices, we got to talk about some terminology. Okay, because bonds have a different lingo than equities. When we talk about bonds, one of the first things we talk about is the face value of a bond, the par value of a bond. When a bond is first issued into the market and you want to purchase the bond before it begins trading, you're purchasing that bond at the face value, and that face value is $1,000. Okay? And I know you're asking, why is it $1,000? I will prove it to you, and I will show it to you in Excel why it must be $1,000. Okay, it absolutely must be. It has to be, right? So you have a bond that has a face value of $1,000, right? Along with that bond will pay you interest, okay, at a particular rate. We call that the coupon rate, the percentage of interest that bond pays based upon the face value of the bond. So if you have a bond that pays a 5% coupon rate, okay, then you get $50 a year. Okay, 5% times 1,000 is $50. You get $50 a year. Okay, that $50, the actual dollars that you'd receive from that bond payment, is what we call the coupon. Okay, and the reason why it's called a coupon dates back to 50 plus years ago, when if you owned bonds of a particular company, you actually had physical pieces of paper that were the bond. And on the right-hand side of the bond would be a perforation. And you, every 6 months, when you were entitled to go collect the coupon for that bond, you would tear the coupon off, okay? And you would take it to your bank and you would sign it, and the bank would give you money in return for you giving them the coupon off of the bond. Okay, so that's where the term coupon comes from, right? So you've got $1,000 face value, $1,000 par value. You get paid a particular rate, an interest rate, the coupon rate based upon that $1,000 par value, and you get paid the dollars in the form of the coupon, okay, on some frequency. Okay, in general, bonds will pay semi-annually, so every 6 months, all right? At some point, the bond matures. Okay, the bond exists for a period of time. It's a 5-year maturity, a 10-year maturity, a 30-year maturity. Okay, but there is an end date for which the bond issuer, okay, is required to make those coupon payments before it returns the $1,000 principal back to the bondholder. Okay, so at some point in time in the future, Okay, you get $1,000 back, not adjusted for inflation, not adjusted for anything. You get $1,000 back if you hold it to maturity. Okay, and then you have this final bullet. Okay, so everything else, everything to this point should be fairly self-explanatory, right? You buy the bond on day 0 of trading. The bond issuer agrees to pay you the coupon rate. You receive the coupon dollars at the set intervals, and everybody's happy. Problem is, things change. The economy changes. Inflation happens. Global events happen. An oil crisis occurs. The coronavirus pandemic. Things within the economy change that impact the supply of money, the demand of money, aka changes in market interest rates within the environment that you're operating within. Okay? The specifics about the bond that you bought, those don't change. You get the coupon rate on that $1,000 par value for as long as you hold the bond. But that doesn't mean that the price of your bond is $1,000 anymore within the market. Okay? If interest rates change within the market, okay, the value of your bond changes. Okay? So for example, you have a $1,000 bond that you bought that pays a 5% coupon, okay? Meaning that interest rates in the market at the time the bond was issued are trading at 5%. That's great. But then all of a sudden, let's say, inflation starts to kick in, okay? And the Fed enacts some monetary policy changes to raise interest rates within the market to stem inflation. And so therefore, new bonds that are being issued into the market are now being issued at a higher rate than what your coupon rate is on the bond that you bought, okay? Think about it. If you wanted to sell your bond that only pays 5% coupon rate and new bonds in the market are being issued at 6%, what do you have to do to the price of your bond in order to get somebody to purchase your bond? You've got to sell it at a discount. Okay, so the relationship between bond prices and interest rates, changes in interest rates, all right, are inversely correlated. Okay, so we're going to get into Excel here in a minute, and I'll show you what all that looks like. But the yield to maturity, okay, is the rate of return that's required in the market. Okay, the rate of return that's required in the calculation of your bond price, okay, in order to make the bond price what it is as it's being traded in the market. And we'll see that here as an example in a second. So when we think about how the bond price is calculated, okay, we got to think about the cash flows of the bond itself. Okay. And what I want to do here is I'm going to try to make this work again tonight. It didn't work the last time, but it worked earlier today in my other class. So I'm going to try to make this work here with my iPad. And I'm going to cut over to whiteboard and see if we can't have a conversation about what this looks like. Okay. So I'm going to new share, go to my iPad and see if I can make this. This is really strange. Like it works fine on my other Zoom account, but I don't know. Let me see if I can just do this real quick. Hopefully it won't take very long. Oh, okay, well, maybe that just worked. Oh, it did. Maybe, hold on. Okay, here we go. All right. Give me just a second here. All right, here we go. All right, we're in the money now. Okay. I'm assuming everybody can see this at the moment. Okay. So when we think about the cash flows of a bond, right? we think about the cash flows of a bond and we have a timeline. Okay, and we have time 0, 1 year, 2 years, 3 years, 4 years, 5 years, 6 years. Okay, so we have a bond, all right, that has a 6-year maturity. Okay, that on day 0 is priced at $1,000 par value at a 5% coupon. Okay. Okay, let's think about this in terms of cash flows. Okay, so let's look at the cash flow stream of this bond. Okay, and we're going to assume annual compounding just to keep things simple, right? So in year 1 that you own this bond, you get $50, right? Because you get 5% of $1,000 in the form of a coupon every year that you own this bond until maturity. So you get $50 in year 1. You get $50 in year 2, $50 in year 3, right? Okay, and you get $50 in that last year, right? So that's cash flow stream number 1. Okay. What's the other cash flow stream that we need to account for in this example?
$1,000 par at maturity.
Right. So eventually this bond matures, right? And we get the $1,000 back. And we get that $1,000 back in the year that the bond matures according to the bond indenture specifics. And in this case, it's a 6-year bond. So at the end of that 6th year, in addition to the $50 coupon that we get, we also get the $1,000 back, right? So we have cash flow stream number 2. Right? So when we talk about how we go about pricing a bond, what's the value of the bond? Where does this $1,000 par value come from? It's comprised of 2 things and 2 things only. Okay, it's comprised of the present value of all the coupon payments, okay, plus the present, the present value of the future value at maturity. Okay, that is how bonds are priced, right? It's comprised of those 2 things. The present value of the stream of annuities payments that you receive in the form of the coupon payment, right? And what's the present value of that future $1,000 in whatever year that it eventually matures. Okay, and so when we do that and we take the present value, and we're going to use Excel to go through an example of this here in a second. When we use Excel to calculate the present value of all of those coupon payments, and we add that to the present value of that future $1,000 return of principal in whatever year the bond matures, that is the price of the bond. Okay, so let's go ahead and go to Excel. And I'm going to stop sharing that because now that it works, I know that it works, and which is awesome. Okay, so the bond value, okay, is equal to the present value of the coupons plus the present value of the par. Okay, or in terms of what we've already talked about, it's the present value of some annuity plus the present value of some future lump sum. Right? You already know how to do it. Now we're just taking what you already know how to do and we're putting it into a different context in the form of bonds. Okay? So if we remember, based upon the present value and future value formula, right? Present value equals future value times the discount factor. And the discount factor is equal to 1 divided by 1 plus r raised to the time period, right? So if interest rates go up, all right, the discount factor gets lower. And if the discount factor gets lower, then the present value of those future dollars goes down. Therefore, as interest rates go up, the present values must decrease. Hence the inverse relationship between bond prices and interest rates. Okay. Do I need to go back to my Word document and draw that out, or can you guys conceptually see that in your head? Because I can go back and kind of make it a little clearer if you want. Just hit the chat room and ask me, and I'll go back and do it. So as interest rates go up, remember, present value equals future value times discount factor, and discount factor is equal to 1 divided by 1 plus the rate to the time period. So if your rate is in the denominator, okay, your discount factor will decrease as rate goes up. Therefore, present values of that stream of money is going to decrease as rates go up. And if the price of the bond is equal to the sum of all of those present values, then as rates go up, the sum of all of those present values must go down. Therefore, the price that the bond is trading at within the market must also go down. Okay. And we can see that here. All right. Now, you don't have to memorize this formula, but you need to understand, like, this formula is what you saw weeks ago when we were talking about what the present value of an annuity is. Okay, a consistent payment, the coupon payment. Okay, what's the present value of a stream of cash flows that is consistent over a period of time at the same rate? That's what this is. That's the present value of the coupon annuity, plus the present value of that future return of principal, that future return of par value, whenever that exists or whenever that comes. Okay. And when we get to how do we go about calculating the stock price, when we get to equity valuation next week, this is going to become crucial in our analysis. Okay, so bond value is the present value of the coupon annuity plus the present value of the future par value. So risk in bonds, okay, within the bond market, right? Of course, there's price risk, okay? Because as we just proved mathematically, the price of bonds is going to change based upon the interest rates that are in the market at the time. Not so much the interest rate of the coupon rate of the bond that you own, because the coupon rate of the bond that you own was dictated by the interest rates in the market based upon the time that the bond was issued, not at the point in time that you're currently in. Okay, long-term bonds have more price risk than short-term bonds. Why is that? Why would a long-term bond have more price risk than a short-term bond? Think about that future value formula. Think about how a bond price is calculated. Why would a long-term bond have more price risk?
Like more interest rate volatility.
Not so much interest rate volatility, but yes, you're right. There are more periods of time within which the bond could be impacted by changes in interest rate between the time that you're looking at it and the time the bond matures. That is a fair statement to make, okay? But also, more importantly, just from a static standpoint, all right, within the future value formula, you have more time periods, right? You have more time periods that you're considering for a longer term bond than a short term bond. Right? So therefore, they are riskier in terms of interest rate risk and price risk for long-term bonds versus short-term bonds. So you're not wrong. It's just supplementing what you said. Okay, so nice job on that. Okay. We've also got reinvestment rate risk. This is a big one, right? Because there's a big assumption that gets made, right? And we're going to talk about this as it relates to yield to maturity or yield to market. Okay. You get paid a coupon rate, okay? And that coupon rate is the same, no matter what's going on with interest rates in the marketplace. You bought the bond at $1,000 or whatever price you bought it at, and it's paying you 5% according to the bond indenture. Forget what's happening with interest rates within the market. The yield to market is designed to give you an idea of what you need to be able to reinvest those dividends at in order to achieve the final yield to market that the bond is being priced at. Okay, so when we talk about reinvestment rate risk, there's no guarantee that you're actually going to be able to reinvest that coupon that you receive at the yield to market. Okay, and we'll get into an example of that in Excel here in a second. So when we talk about calculating yield to maturity, okay, and we just walked through how to go about calculating the bond price, right? Well, the yield to maturity is simply the rate, okay, that is required in that bond formula that we just went through, the rate that is required in order to force the price of the bond to be what it is. Okay. So if you were doing this by hand, all right, it would require trial and error. But fortunately, we have God's greatest gift to man in the form of Excel, all right? And Excel will do this for us, okay, via the rate function that you've already used. Okay. If we had more time, all right, or if you were taking an entire semester around bond valuation, we'd get into a much more detailed calculation using the equals yield formula within Excel. But for this class, we're just simply going to use what we've already talked about, equals rate, okay? Because we'll know how long the bond has until it matures. We know what the future value is of the bond because it's $1,000 at that point in time in the future. We know how many times a year we're going to get paid the coupon. We know what the current price of the bond is. So as long as we have all of that information, we can calculate what the yield to market is, the yield to maturity is, okay? And that'll get us into, if the yield to maturity is greater than the coupon rate of the bond, why the bond is trading at a discount to par. Okay, we'll see that here in a second. Okay, so let's go ahead and let's get into an example here within Excel. And what I want to do is find that one, and I'm going to kind of close this down a little bit, and I'm going to open my Excel back up, and let's just kind of get into an example of how we use Excel to go through a really quick and dirty example. The first thing that I want to do is prove to you why the $1,000 par value is no mistake, okay? Why it must be $1,000, okay? So in this case, what I want to do is we're going to just write down a couple of variables, okay? So we're going to have the par value. Let me just make this a little bigger. Okay, so we're going to have the par value. We're going to have the coupon rate. Okay, we're going to have time to maturity. Oops, maturity. It's my southern accent coming in there. Okay. So in this case, our par value. So we're going to treat this example, we're going to start looking at this example like at day 0, okay? Once the bond indenture gets created and the bonds get sold to the initial investors who are buying all of this, they're buying the bonds at par value, which is, we're going to say $1,000, okay? And I'm going to prove to you why this must be the case here in just a second. Okay, we're going to use the same coupon rate of 10%, okay? We're going to use the same, we're going to use years to maturity of 20 years, okay? Okay. And now let's think about the different components to how we go about pricing this bond, okay? So the first thing we have to figure out is, what's the present value of the coupon annuity? What's the current value in today's dollars of the next 20 years of coupon payments? Okay. Again, let's add another line in here, and let's talk about compounding periods, because this is going to be important. Okay. So we have two per year. So semi-annual compounding. Okay. We got coupon rate, we got time to maturity, and we got compounding periods. And we know we've got a par value of $1,000 bucks. Okay. So part one is, what is the present value of all of those coupon payments that we're set to receive? Okay. Well, again, you already know how to do this. Equals PV equals present value. And now it's just putting the appropriate numbers in. Okay. We know we have a rate. It's 10%, right? And we know that it's 2 times a year, so we have to adjust for compounding. So 10% a year divided by the number of compounding periods. Okay. How many compounding periods do we have? Well, we have 20 years, right? Times the number of compounding periods per year, right? Now, PMT, this is the coupon payment. How much money are we getting every compounding period? Well, it's 10% times the par value. So it's $100 a year divided by the number of compounding periods, right? And that's it. Because remember, step one is we're only dealing with what the present value of the coupons are, nothing else. So there is no future value. There is no future value for part one. So we've got the rate adjusted for compounding. We've got the number of periods adjusted for compounding. And we've got the number, the dollar amount that we're receiving in the form of the coupon payment each compounding period. And when we do that, okay, the present value, okay, how much we would be willing to pay today for that future stream of coupon payments, 40 periods of coupon payments, right, at 50 bucks a period, we'd be willing to pay $857.95. That is the present value of that entire stream of coupon payments. Okay. Part two, what's the present value of the future lump sum? So the PV of the FV, okay? The present value of the future value, or the future, if you want to call it future par value, okay? Again, the same formula. It's a present value calculation, equals PV, okay? Same thing. We've got a rate. We adjust for compounding. We got a number of periods. We adjust for compounding, okay? In this case, we're not dealing with a payment because we've already taken care of the payment, because the payment is the coupon. We dealt with the coupon in part one. So there's no payment. So we just comma through the payment. And now we put in the future value. What's the future value? Well, we get the $1,000 back. So that it's simply the $1,000 coming in the door. So the sign is positive. And we close it out. So before this bond starts trading, you can now see that the $1,000 par value is not just some random number. The $1,000 par value must be what it is, because the present value of all of those future coupon payments plus the present value of that future par value at maturity at the coupon rate that is listed in the bond indenture, it must be $1,000 before the bond starts trading in the market. I'm going to pause here for one moment, and I want to ask if you have any questions about this before we move into the question that deals with yield to market, because yield to market gets into it, layers on another concept above this, that if you don't understand this, it's going to be more challenging for you to understand the yield to market. Are there any questions about this? How the bond prices are calculated? Anybody do this anybody do this in their job? Is anybody responsible for actually doing this kind of math within the work that you do? Most of you probably have computer systems that do it for you.
Professor, how does someone come up with par value to begin with?
By doing exactly what we just talked about. We just came up with the par value. That is exactly how par value is determined. What's the present value of all the future coupon payments, plus what's the present value of that future $1,000 coming back to you? And the two of those things equals $1,000, and therefore the $1,000 must be par value.
So, but don't you, so the future value of the $1,000 coming back to you, you have to have had the $1,000 to start to calculate that, right? Like, I feel like it's circular. No?
It looks like it is quite circular, isn't it?
Mm-hmm.
Okay, but that is exactly that is exactly how it was determined.
Okay.
Okay. So let's take it to the example that's within the PowerPoint presentation. All right, and let's look at the question here. All right, and let's look at calculating what the yield to market is if the bond is selling for the price that it's listed here of 11.97 spot 93. Okay, so we've got all of this same information. Okay, except now we're given the current price of the bond. Okay, of 11.97 spot 93. Okay, and we want to know what the yield to market is. What's the price? What's the rate that's required in the market, okay, in order to force these two components of the bond to be equal to the current price of the bond, okay? The bond is clearly trading at a premium to par value, so it's trading at a higher value than what is existed within the bond on the very first day of trading. So what's the yield to market? Okay, so in this case, we're talking about the rate function. We want to know what's the required rate of return in order to make that price be what it is based upon the coupon payments that we're going to be receiving and the $1,000 that we're going to be receiving in the future. So equals rate, okay, and it tells us, right, number of periods times the number of compounding periods per year, okay? What's our coupon payment that we're getting for the bond? Well, we know we're getting 10% times the $1,000 divided by 2 times a year. We know what the present value is of the bond. Okay, remember negative because it's cash out for PVs. And we know what the future value is because that's the par value. Right? So rate, we have to give it the number of periods remaining. We have to tell it the coupon that we're receiving because it needs to figure out what the present value of all of that is. We need to tell it what the current price of the bond is, and we need to tell it what the future value of the par value is at that period of time, 40 compounding periods from now. Okay, and we get 4%. But wait a minute. That's 4%. That's not 8%. Why do we have a difference? I mean, we did the math right? I mean, shouldn't we have gotten 8% by doing this?
Adjust it for compounding afterwards.
Thank you very much. We have to now, because we're doing all of the math. Remember, we're doing all of the math based upon the compounding parameters of the bond. And since this is a semi-annually compounded bond, this 4% is the semi-annual yield to market. So we have to multiply it by the number of compounding periods to get to the annual rate of 8%. Okay, so don't forget. Oh, duh, it's right there in the notes. So you guys should have seen the clue right there. But yeah, we got to adjust. We got to adjust the calculation to get it back into annual terms. Okay. All right. So let's go in and let's look at this through a slightly different lens. And we're going to get into current yield of the bond and capital gains yield on the bond. And we'll see how the calculation that we just did in terms of yield to market can also be determined simply based upon a current yield and capital gains yield calculation. Okay. So in this example, we've got the same bond, same current price, same future par value, same years to maturity, but we can calculate, okay, the current yield to market by looking at two components: the current yield, the yield that the bond is producing, okay, based upon the dollar amount of coupons that we're receiving and the current price of the bond, and the capital gains associated on the bond. So the current yield is nothing more than the annual dollar amount of coupon that we get, so the $100, divided by the current price of the bond. Okay, so you can think of this as kind of like the interest rate that you're receiving by owning the bond. So 8.35% is the current yield of the bond. Well, we've also got to factor in any sort of capital gains that we might incur if we were to sell the bond at the current price, or losses as the case may be from time to time. So the capital gains is nothing more than just price change. Okay, so if we expect the price in 1 year, okay, assuming no change in the yield to market, we expect the price to be $11.9368 and the current price is $11.9793, then our capital gain is the price we're going to sell it at minus the current price that we're buying it at, divided by the current price that we bought it at. So we get a negative 0.35%. We're taking a 35 basis point loss from a capital gains perspective if the future price of the bond drops to 11.9368. So when we take the current yield and we add that to the capital gains yield, we get 8%, which is the exact same yield to market that we calculated in the prior example. Okay. So we can do it both ways and get to the same result. So when we take a look at a graph of yield to maturity, okay, or rate.
Hey, Professor.
Yep.
Is there a way that you can go back to the Excel sheet for the yield to maturity? Mine, I must have missed a step, is showing 4%.
Yeah, you just multiply by the number of compounding periods.
Perfect. Okay.
So you got this.
Yeah.
Okay. But remember, we're doing all the math based upon a certain number of compounding periods. So the result that you get is on a per compounding period basis. So the final answer that you need to get on an annualized basis has to be the value that you calculate multiplied by the number of compounding periods per year.
Okay, perfect. Thank you.
Okay, yep. Okay. So when we look at a graph of how interest rates, okay, or yield to maturity relates to bond prices, the relationship between bond prices as yields change, we can see that there's a shape to this curve. All right. And that's because of the time value of money formula that is exponential in nature. All right. So again, if you were taking a more advanced course in bond valuation, we'd be talking a lot about something called duration, okay, which is the first derivative of this line, all right, which would be somewhere like a straight line that runs probably like right through there, okay, all right. And then we'd be having a conversation around a term called convexity, which is the rate at which the bond price changes, okay, based upon the first derivative of the bond price as it relates to changes in interest rates, okay? So, but the only thing you need to know about for this course is simply bond prices and rates, all right, are inversely correlated. As rates move up, bond prices move down. As rates move down, bond prices move up. And we saw that just simply based upon the math using the time value of money formulas. So if we think about the math, naturally, if the yield to market, we'll go back to Excel here, if the yield to market, okay, if the yield to market is equal to the coupon rate, then the par value must be the bond price. Okay, so in the very first example, if the coupon rate was 10% and the yield to market was also 10%, okay, then the bond price is equal to the par value. Okay, the bond price is the par value. If the yield to market is greater than the coupon rate, okay, if the yield to market is greater than the coupon rate, meaning this coupon rate changes upward, okay, then the par value must be greater than the bond price. Okay, let's take a look at that example. Actually, I want to do it down here. Just keep going. Okay. So in the case of a 12% yield to market, the bond doesn't change. You bought the bond at 10%. You're going to get paid that 10% of par value for as long as you hold the bond. But the yield to market is going to change based upon the environmental conditions within the market that the bond now exists within. Okay, so we now have to discount those future cash flow streams by the current market rates, which was why we now use the yield to market in the calculation for the present value of the coupons and the present value of that future value in the determinants of the new bond price. So if, in this case, if the instant that this bond starts trading, the new yield to market is 12%, we've got a totally different scenario now. Still mathematically, formulaically, the same thing that we need to do, so equals PV, except now we have a rate of 12%, okay, obviously divided by 2. We still have the same number of periods, 20 years times 2, 40 compounding periods. Our payment, though, our payment is still based upon the bond indenture, which is 10% of par. So we still have the coupon rate times the par value, okay, annually, divided by 2 for the semi-annually compounded rate, okay? And now we have changed the equation. Now we're discounting the future value of all of those coupon payments, which were set by the bond indenture. We're discounting it at a higher rate. So we should expect to see the present value of all those coupons be less than $857.95. And let's see if that's factual. And it is, okay? Because the rate at which we're now bringing those future cash flow streams back into today's dollars is higher. And because that rate falls in the denominator of the discount factor, when we take the future value times the discount factor at a higher rate, the present value of that future dollar is less than what it would have been because we're discounting it at that higher rate. Okay, so we now have the present value of the coupons at a 12% yield to market, now equal to 752.31. And when we do the same thing for the present value of that future par value, we're using the same rate, the yield to market, divided by the number of periods, number of compounding periods, right? Obviously no payment because we're just dealing with that future value. And the future value is still $1,000. Okay. So now the new The bond price now the same bond, you own the same bond, right? It's the same 10% coupon rate bond, 20 years to maturity, but rates in the market have moved up to 12%, and you're getting 10% for your existing bond. So your bond in the market is now, whoops, that was bad. What's going on? Okay, your bond in the market is only worth $849.54. Okay, no longer worth $1,000 in the market. If you hold it to maturity, you get your $1,000 back. But if you wanted to sell it in the market today, and current yields in the market are 12%, then the price of your bond is no longer $1,000. It has now dropped from $1,000 to being what we call a discount bond and trading at $849.54. Okay, so if the yield to market is higher than the coupon rate, then the par value is greater than the bond price. And we see that par value greater than bond price. Okay, if the yield to market is less than the coupon rate, then the par value is less than the bond price. So conversely, if we took the yield to market from 12 to 8, right, now the price of our bond is trading at 1197.93, which is no coincidence. That's the same yield to market that we calculated in the example before. Okay, we took the yield to market to 8%, which is what we calculated. So we just proved to ourselves that if we do that, then the price of the bond is 1197.93, which is exactly what we were told the price of the bond was at a yield to market of 8%. Okay, so when you have a yield to market that is below the coupon rate, okay, you're discounting at a lower rate, meaning you got a lower rate, you've got a higher discount or a smaller discount factor, let's put it that way. You have more present value dollars, okay, think of it that way, than you would if you were discounting at a higher rate. Okay, so therefore the price of the bond has to go up, right? And if you think about it from a supply and demand standpoint, it makes kind of perfect sense. If your bond's paying 10% and new bonds are being issued into the market at 8%, then you ought to expect to get paid more money for the bond that you own that's paying at a higher rate than what the market is paying at. This is just the math around how you go about determining what the price of that bond looks like. Okay. Right. So we have pretty much already gone through these examples. Right. So when we talk about the sensitivity to bond prices against interest rates as it pertains to the length of time a bond has to maturity, okay, we can see the example right here. Okay, a 1-year bond, very short time frame, okay, that exponent t, right, that's a 1, right? The present value calculation for this bond has 1 time period that it's dealing with, right? The present value calculation for the 30-year bond has 30 time periods that it's dealing with. So you can see that the 1-year bond at interest rates ranging from 5% to 20%, the price fluctuation in those bonds is minuscule, from 1047 to 916. Okay? But when you stretch it out to a 30-year time horizon, now you start to see a shape, a sensitivity that the bond price has as it relates to the interest rate. Okay. And again, the shape of this, the first derivative of this 30-year bond curve is what we call duration, modified duration. And the convexity, the degree at which the bond price changes the farther away from that first derivative that the bond price gets, right, is much more pronounced on longer term bonds than short term bonds. Okay, and that should make perfect sense to you conceptually when you think about the time value of money formula. Okay, if you're dealing with a time frame that is part of the exponent, right, of the denominator of the present value formula, then you should expect to see a drastic change in sensitivity over a longer term bond than a short term bond. Okay. So when we think about how we find the value of the bond, all right, it's two things. It's the present value of the coupons plus the present value of that future par value whenever we get it back at maturity. Plain and simple. It's just the sum of those two things. Okay. And then if we want to find the yield on the bond, okay, what's the required rate of return in the market to force the bond price to be what it is within the market? Then we're using that equals rate formula within Excel. Okay. And when we're trying to find the current price of a bond based upon a given yield to market, we're discounting, okay, we're discounting those coupon payments and that future value at the yield to market rate. Okay, our coupon payment doesn't change. Okay, you get 10% a year on $1,000 par value. That doesn't change. We still get $100. All right, but the future value of that $100 a year is still $100. But the present value of that $100 a year is going to change based upon the yield to market. Okay? And you'll have an opportunity to get comfortable with these calculations between now and next Monday through some connect work, as well as a very small mini case study, like really small mini case study on the Walt Disney, and they call them the Sleeping Beauty bonds. It was a 100-year bond that was issued back in, I think it was 1993. And you'll be able to go through and calculate what the price of these bonds looks like on the day of issuance or at different changes in interest rates. And then you're going to create a graph that shows what the sensitivity to the bond price is as it relates to interest rates for these Sleeping Beauty bonds. You'll have a chance to do that as an actual exercise. Okay. So that's all for like the math tonight. Okay, so before we get into winding it down and getting away from the math, because in many cases I like to start the class with the math, because by this time of the night we're all bonked, we're all tired, and if I started trying to show you the Excel formulas for how to calculate bond prices at 8:30 at night, I think I'd lose everybody. Does anybody have any questions about the math around bond pricing? I hope to God I'm still recording this, because I don't want to have to go back and re-record this. Let me see, hold on a second. Yes, I'm recording. Hot damn. Okay. Okay, so let's talk about the bond indenture. Okay, I've used this word a few times tonight. Okay, and the bond indenture is, for all intents and purposes, nothing more than the document that is created by the bond issuer that details all the provisions of the bond. All right. How many times a year are they going to pay the coupon? What's the coupon rate? What's the par value? Okay. What collateral is being posted by the bond issuer, okay, to support the underwriting of the bond issuance? What other provisions exist within the bond? Something called a call provision, meaning does the bond issuer have the right to buy all the bonds back at a certain point in time in the future that is earlier than when the bond matures according to the bond indenture? Okay. And there are definitely times in which a company might want to do that. And I want you to think about that, because when a couple slides from now it's going to come back, I'm going to ask the question, why would a company want to use a call provision allowing them to repurchase all of the bonds, okay, in the marketplace? Right? We've got different types of bonds, registered versus bearer forms. I'm not going to test you on any of this stuff. You've got different types of classifications as it relates to the security of a bond. What is underlying the bond indenture? If something goes wrong and the bond issuer isn't capable of paying their coupons, okay, what do the bond holders have access to in order to force the bond issuer to sell certain assets, collateral, whether that's the mortgage on the buildings or notes or other forms of collateral in the form of financial securities that the bond issuer might have, okay? What gives the bond holder more assurances, okay, that the bond issuer is going to be able to continue paying the coupon for the period of time until the bond matures, okay? And we have certain things like seniority, okay? So secured debt is debt that is secured by other collateral within the firm, whether it's in the form of financial securities or backed by the physical real property that might exist within, say, a power plant or a chemical company, okay? Someone could go in and sell a big compressor to generate money that could then be used to pay off the bondholders, okay? But it's in layers of seniority, okay? Banks generally being at the top because they always want to get their money back. Okay? Moody's and Standard & Poor's rate bonds just like they rate, equities, stocks within the market. If we're talking about firms from a Moody's standpoint that have a BBB or higher investment rating, then we're considered those to be investment grade quality bonds, okay? Their risk of default is low. Okay, under normal operating conditions, investment grade and higher bonds, rated bonds, have a low risk of default. However, if the environmental conditions, the economic conditions within which these companies operate changes adversely, there could be the possibility that the bond issuers might have a more challenging time living up to their commitments, okay? But it would have to be something pretty drastic, in which case you're not necessarily so worried about the individual bond you own. You got a lot of other things you're also worried about as well. So investment grade and higher is BBB or better from a Moody's standpoint. So, or BAA from Moody's and BBB from S&P. Okay, anything below that is considered to be low grade or junk type bonds. And let me tell you, if you're buying a junk bond, by God, you better be compensated with the commensurate level of risk that you're taking, because if you're going to buy a junk bond, you better have a pretty good yield. You better have a pretty good coupon rate on that bond, because you're taking a lot of risk of default for those bonds. And so if you're going to take that level of risk, by God, you better be getting compensated for that level of risk in the form of a higher coupon rate. Okay. When we talk about government bonds, we got bonds that are issued by the federal government, okay? Treasury bills, treasury notes, treasury bonds, right? If you see a question on the final exam, okay, that relates to government bonds, all right, you're going to see one that is more of like a multiple choice question about maturities. You need to know that treasury bills are pure discount bonds that mature within 1 year or less. Okay, we'll talk about what a discount zero coupon bond is here in a second. You need to understand that treasury notes, okay, are debt that have maturities between 1 and 10 years. And then treasury bonds, T-bonds, have maturities that are greater than 10 years, okay? So T-bills trade at a discount, 1 year or less. Treasury notes pay coupons, okay? So treasury bills trade without a coupon. Treasury notes trade with a coupon, but with maturity dates between 1 and 10 years. Okay. Treasury bonds trade with a coupon with maturity dates beyond 10 years. Okay. We have municipal securities, right? These are bonds that are issued at the state and local level, right? So you can buy a general obligation or revenue municipal bond, okay, within the state of Maryland for specific projects at the state of Maryland or Baltimore County, okay? or Baltimore City is looking at doing, and they're issuing bonds to help pay for the projects. Okay. They do have varying degrees of risk based upon the general credit worthiness of the municipality or state government that is issuing the bonds. Okay, so you need to pay attention to that. The nice thing about buying municipal bonds in the state and the locality that you might live is that if you buy a Baltimore County bond in the state of Maryland and you live in Baltimore County, then you don't pay any tax on the coupon that you receive, okay? At the federal, at the state, or the local level. It's what we call triple tax exempt, okay? And there was a Supreme Court case a number of years ago, which is what resulted in that triple tax exempt status for municipal bond purchases. Okay, so zero coupon bonds, right? So what are zero coupon bonds? All right, well, treasury bills, right, T-bills are zero coupon bonds. When you buy one, you're not getting a coupon. You're not being paid any form of regular interest, okay? But in return for buying a zero coupon bond, you're buying it at a discount. It trades at a discount. So the entire yield to maturity of a zero coupon bond, okay, comes from the difference between the purchase price and the par value of the treasury bill that you purchased, okay? And therefore, by definition, the zero coupon treasury bill can never trade more than par value because it can never exceed the value of par of 1,000. Okay, so sometimes we call these zeros or OIDs, original issue discount bonds. Floating rate bonds, right? I'm just going to kind of wing through this because you're not going to be tested on this, but you need to know that they exist, all right? Coupons that are bonds that have bonds that trade with coupons that vary depending upon some base rate within the market, okay? Whether it's, call it the consumer price index for inflation. The coupon rate at which you would receive coupon dollars will be adjusted up or potentially down depending upon the particular index that that floating rate bond is marked against, okay? Adjustable rate mortgages, inflation-linked treasuries, TIPS are good examples of these types of floating rate bonds, okay? And look, the great thing about Wall Street is also one of the things I hate about Wall Street. They create and craft so many different products on any given day. There's pretty much a bond that exists for every type of scenario that's out there, and ones that probably haven't even been invented yet because we haven't faced the situation that we'll face that will result in the creation of new bonds. But you got catastrophe bonds, income bonds. Convertible bonds are fairly common. That's if you buy a bond that has a convertible provision within it, it will give you the right as the bond holder to convert your bond shares into common stock shares. So if you believe that the value of the common stock of whatever, call it General Electric, if you believe that GE as an individually publicly traded company, the value of that stock price is going to exceed the value of the bond that you hold, you have and the bond that you hold has a convertible provision within it, you can convert, your shares of the bond into common stock shares at some given conversion rate specified within the bond indenture. Okay. Again, I'm not going to test you on conversion, provisions within the bond indentures, but you need to know that they exist. Okay. Bond markets are not very liquid. Okay, I'm going to tell you that right now. You can buy one, okay, and you can go out to the over-the-counter market and you can buy a specific bond for whatever Baltimore County revenue bond for a new tollway that they're going to put going up 83. I hope they never do that, but if they did, they would issue a bond to help build, the toll, and you could purchase one of those revenue bonds and you'd own a single bond tied to that very specific project. all right? But you can imagine that within the entire populace of investors, there's a very small population of people that want to buy the bond very specific to the tollway going over 83 at Padonia Road in Baltimore County in the state of Maryland. Okay, so they're not very liquid. So most of the time when we look at investing in bonds, we're investing in bonds via mutual funds or versus exchange traded funds. Okay, which also means that because it's not very liquid, it means that getting prices for these individual bonds is somewhat challenging to get. Okay, because we're talking about single issues. We're not buying basket of bonds like we would be buying if we were purchasing, you know, the short-term corporate bond ETF from Vanguard, you know, BSV. Okay. So how do we go about quoting bonds within the market? If you looked at a bond quote, this is something that you would see. You'd be told when the maturity of the bond is, 2036, February 15, 2036. You'd be told what the coupon rate of the bond is, 4.5%. You'd be given a bid price and an ask price. If you own the bond already, the market maker is telling you here with the bid that they'd be willing to pay you 128.0781 for your bond. Well, that doesn't look like, you know, a whole lot like $1,000. Well, that's because bonds are quoted in terms of percentages. So this is actually 128% of the $1,000 par value. Okay, so the actual price that this market maker would be willing to buy the bond from you at would be $1,280.78. Okay, so it's clearly trading at a premium to par, because if it was trading at par, the bid would be 100 even. Ask if you are looking to purchase this bond. This is what they'd be willing, the market maker would be willing to sell you the bond for. Okay, so if you were looking at buying this bond, you would pay $1,281.41 approximately to purchase this bond. Tells you the change day over day, and it gives you the yield to market, or the asked yield. All right, again, that is simply the yield that is calculated in order to force the prices to be what they are. Right? So coupon rate 4.5, matures February 15, 2036. The bid price, what they would be willing to take it off your hands for, what they'd be willing to sell you the bond for, okay? How much it changed versus the previous day, okay? And what the yield to market is based upon the current ask price. Right? So that's how the quotes work for bonds, right? In the Connect homework, the Connect assignment, there'll probably be a couple questions that deal with this. Okay, so just understanding the terminology and the lingo around how bonds are quoted and how they're transacted. Okay. So when we talk about inflation and interest rates, this is a big deal, right? So we are, I promise you, we are almost finished. Okay, we've got 1, 2, 3, we've got 4 slides before we're done tonight. Okay, so stick with me. Okay, I know everybody's exhausted. Okay, so when we think about real rates of interest or nominal rates of interest, right? Real rates of interest are simply a gauge of our change in our purchasing power. Okay, and nominal rates of interest, right? It's the quoted rate of interest, meaning just the change in the actual physical number of dollars. And you'll see the distinction here in a moment. So when we talk about the nominal rate of interest, okay, that includes, right, our desired real rate of return, okay, what we want to get on our investment, plus some adjustment for inflation. Okay, we want to, at a minimum, keep up with inflation in terms of our rate of return. So our ex-ante nominal rate of interest, okay, needs to include both our desired real rate of return in addition to our projection for inflation. And that gets us into what we call the Fisher effect. And the Fisher effect is a relationship that exists between the real rates of return and the nominal rates of return as it pertains to the incorporation of inflation into our expectations. So the Fisher effect, okay, is what you see here, right? So 1 plus the nominal rate is equal to 1 plus your real rate times 1 plus the inflation rate, right? And we can approximate the Fisher effect with the nominal rate being equal to the real rate plus our inflation rate. Okay, so if we need to have, okay, a nominal rate of return of 10%, okay, and inflation is projected to be 3%, okay, then our real rate of return on that investment needs to be 7%, because 7% plus the 3% inflation rate gives us our desired nominal rate of return of 10%. Okay. We'll see where that relationship between the actual Fisher effect, okay, and the approximation kind of breaks down a little bit in this next example here. So if we require a 10% real return and we expect inflation to be 8%, what's our nominal rate? Okay, so our nominal rate is, by rearranging for capital R, we get 18.8% for our nominal rate, okay, if using the Fisher effect formula. If we simply use the approximation where we take the real rate plus the inflation rate, okay, so 10% plus 8%, we get 18%. So we see that there's, an 80 basis point difference between the Fisher effect relationship between the real rate and the inflation rate, simply because the real rate of return and the expected inflation, okay, are relatively high. Okay, so it's creating this larger gap between the actual Fisher effect and the approximation. And we'll see how that comes into play when we look at yield curves, okay, and how interest rates will change over time on different lengths of time. Okay, so there's a significant difference between the Fisher effect and the approximation as your expected returns and your inflation rates get higher. Okay. So when we talk about term structure, now we're talking about the relationship between time to maturity and yields when everything else is ceteris paribus. Okay, so when we look at the yield curve and we think about the yield curve from a normal standpoint, the normal type of yield curve it's a graphical representation of the long-term term structure relationship between interest rates on the y-axis and time to maturity on the x-axis. Okay, so like that. And so in a normal yield curve scenario, we're talking about an upward sloping yield curve where longer term yields are higher than short term yields, okay? Which, if you think about it, makes perfect sense. If you're going to buy a bond with a 30-year maturity, you expect to get a higher interest rate because you're taking more risk, okay? Always get rewarded for the level of risk that you're willing to take. That's also representative, okay, if we believe that we're going to be in a more longer term inflationary type environment where interest rates are going to need to go up over a period of time because economies are growing, and in order to stem the growth of the economy, we're going to need to raise interest rates to control the rate of growth. Okay. Conversely, we have an inverted yield curve where it's downward sloping, where long-term yields are lower than short-term yields. Okay, indicative more of a recessionary type environment or a deflationary type environment. So when we think about how the yield curve is formed, it's comprised of the nominal interest rate. Okay, so the yield curve is the nominal interest rate, and that interest rate is comprised of the real rate, some level of inflation premium. So we're expecting inflation to be upward sloping over the period of time to maturity, indicative of a strong growth economy, okay? And so when we factor in that inflation premium and our interest rate premium, we generate a nominal interest rate yield curve, okay? Some of you have already seen this, the Fed yield curve. That's exactly what this is. It looks a little bit more jagged than what this example looks like, but nonetheless, an upward sloping term structure is indicative of a growth economy, an inflationary economy. So as time moves out, we expect interest rates to be higher the further out the curve we go. We're being rewarded for taking on more risk because we're holding those bonds for a longer period of time. Therefore, the rate of return that we should expect to see on those bonds is higher for longer term bonds than on short-term bonds. In a downward sloping yield curve, okay, in more of a deflationary environment, deflationary, we're expecting the inflation premium to decline over the time to maturity. We still have that base load of real rate. We still have that inflation premium, but it's declining this time instead of increasing. And we still have the same interest rate risk premium, which creates a downward sloping deflationary nominal interest rate yield curve. Okay, so interest rates in a deflationary environment tend to go down over time as it relates to the period of time to maturity. So when we think about the factors that affect bond yields, okay, there's a number of different factors. Okay, so that yield to maturity that we've been talking about and we calculated at the very beginning of tonight is impacted by so many different things. The real rate of interest, the expected future inflation premium, what's the interest rate risk premium? How risky is the bond that we're looking at buying? Okay, what's the rating that Moody's or S&P gave it? How much additional risk on top of the real rate and the inflation rate? How much additional premium am I going to get for taking the level of risk that I'm willing to take? Okay, so that's the interest rate risk premium. The default risk premium. Okay, if you're buying a junk bond, you should get paid extra interest because you're taking more risk by investing in a bond that may actually wind up defaulting one day and you wind up losing all of the money that you put in. Okay, taxability premium, liquidity premium. If you're buying a bond for a very small biotech firm, okay, that only trades like 5 bonds a day versus the maybe tens of thousands of bonds that larger, more publicly traded companies trade, then you better get some sort of premium, okay, for the liquidity or lack thereof of the bond that you're buying. Okay, so those are just simply some of the more basic factors that affect the yields within the bond market, okay, and that also factor into that relationship between the interest rate and the time to maturity. Okay. Okay. That is it for this evening. That is all for bond valuations. I know it's 8:45 and everyone has turned off their video and hopefully nobody is sleeping. I can't tell if anybody's snoring because everybody's on mute. But I hope that this was valuable to you tonight. I will have the mini case. It's like super simple. Posted out there on Moodle. Let me just check my notes. Let me just bring it over real quick, and I can show it to you. So on Moodle here. Okay. You've got the Walt Disney Sleeping Beauty bonds. Okay, there are a couple of questions at the end of the case study. I don't want you to do any of the questions that are listed in the case. I don't like the questions. The Excel file that the guy who wrote the case is absolute complete garbage. So you're going to build your own file. All right, and within your Excel file, you're going to answer these 5 questions. Okay, so within the Excel file, you're going to pretty much answer these 5 questions. All right. You're going to price the bonds. The case uses some retarded, excuse me, I apologize for using that word, some stupid par value of $100, okay, which makes no sense to me at all, but I like the case because it's just a really simple example of how to go about calculating the price of bonds. So use the $1,000 par value that we've been talking about, not the $100 that's in the case. I've already emailed the professor at Harvard who wrote the case to tell me he should probably change that. But just within your Excel file, work through this. Okay, this is not a graded assignment. All right, this is just you getting to work through an applicable real world case that deals with how bonds are priced and how bond prices change. Okay, with interest rates. It's also a really good way to keep you fresh with how to use Excel as efficiently as possible. Because this last question, number 5, you're going to prepare a graph of how the price of the Sleeping Beauties changes as interest rates move from 2 to 20% in 1 percentage point increments. If you do the formula right for the 2%, you should be able to click and drag for the remaining percentages. So just think about how you're going to do that. Okay. But this is not a graded submission. I would like for you to submit it so that I can just take a look at it just to see if there's anything that I can help you with to help you better understand it. But please complete this as good supplement to learning tonight, as well as the assignment that's going to be posted out onto Connect as it relates to bond valuation and interest rates. So with that said, I'm going to stop my screen share here and just see if there's any questions out there before we shut it down for tonight. Again, if you do have questions, I think you found that I'm fairly accessible, fairly available to hop on a Zoom call me, text me, email me. I tend to get back in fairly short order. But I really do appreciate everybody's attention tonight. And again, any questions, please reach out.